Imagine waking up to a life where your money works for you, where the clink of coins in your pocket is replaced by the sweet sound of dividends hitting your account. Picture a world where financial freedom isn't just an idea, but a tangible reality. This is not some far-off dream. It is within reach. For some people, retirement means reverse mortgages or selling off possessions. But there's another option that often gets overlooked. Living on investment dividends, something that can help you earn $2,900 a month. $2,900 a month. That's $35,000 a year. For many people, that's enough to cover living expenses, to wake up and not worry about money. It's like having a secret money tree that keeps growing and providing for you with passive dividends. This journey is about finding the balance that aligns with your dreams. In this video, we're going to show you 3 fast ways to reach that goal. To earn $2,900 a month or $35,000 a year from dividends. Let's dive in. Before we dive into the strategies, let's understand what dividends actually are. Imagine you're a part owner of a company. When that company makes a profit, they have choices. They can use the profit to grow the business, or they can give it to their owners. If a company decides to distribute some of its profit to shareholders, it's called dividends. As a shareholder, you receive a portion of that profit based on how many shares you own. Dividends can be given as cash, either through a digital deposit or a check. Or they can be reinvested in more shares. Companies have different schedules, but many pay every 3 months. Now let us talk about dividend yield. This is a way to measure how much you're earning from dividends compared to the price of the stock. You take the annual dividends per share and divide it by the price per share. For example, if a stock is priced at $100 per share and pays $10 in dividends each year, the dividend yield would be 10%. Dividend yield varies from company to company. Generally, more established companies offer higher dividend yields than smaller, newer ones. Understanding dividend yield helps you evaluate your investments. By investing in dividend-paying stocks, you have the potential to earn regular income without needing to sell your shares. Strategy number 1. Covered call ETF. This is one of the quickest paths to living off dividends. How does it work? The ETF invests in stocks and also writes call options on those same stocks to generate additional income. When the ETF sells call options on the stocks in its portfolio, it receives premium income that is paid out as dividends. There are several popular covered call ETFs to consider: XYLD, QYLD, RYLD, and JEPI. These funds offer attractive yields, often in the double digits. Let's look at their 12-month trailing yields. XYLD has a yield of about 11.8%. QYLD around 11.8%. RYLD similar. JEPI around 8.5%. The beauty of these ETFs lies in their ability to provide income from both dividends and option premiums, resulting in a more stable and reliable stream of passive income. However, it's essential to understand that these ETFs come with some risks. Options may expire worthless, or the stock prices may decline, impacting overall performance. Now, let's apply this to our goal. If John aims to earn $2,900 per month, that's $35,000 per year. With an 11.8% yield, John would need to invest about $296,000. That's quite appealing, isn't it? Especially when compared to traditional dividend stocks. With a 2 to 4% yield, you would need $875,000 to $1.75 million invested. By choosing covered call ETFs, you can reach your financial goal without needing an excessive investment. And because these are ETFs, you're diversified across many companies. This strategy offers an opportunity to generate a steady income stream while minimizing the capital required. It's one of the fastest paths to living off dividends. So here is the summary. Covered call ETFs offer high yields, often double digits. They pay monthly income. They're diversified, but they have limited upside potential. Strategy number 2. High Yield REIT, REIT, stands for Real Estate Investment Trust. By law, REITs must distribute at least 90% of their taxable income to shareholders as dividends. That's why they often have very high yields. There are some great REITs to consider. Two Harbors Investment Corporation, ticker 2, Brandywine Realty Trust, ticker BDN, Orchid Island Capital, ticker ORC. Let us look at their dividend yields. Two Harbors has a yield of about 20.3%, Brandywine Realty around 19.9%, Orchid Island around 19.4%. Historically, REITs have shown solid performance, with an average annual return of 10.8% over the past 20 years. But it is important to know that the amount of money you get from REITs can go up and down. It depends on how many people rent the properties and how the economy is doing. So how much does John need to invest to earn $35,000 per year from REITs? If he expects to get around 10.8% each year, he would need to invest about $324,000. One great thing about REITs is that, unlike regular stocks, they often pay dividends every month. This makes them an even more attractive choice for a steady income stream. A good approach is to diversify across different types of REITs: residential, commercial, healthcare, data centers. Each sector performs differently. A good way to retire with REITs is to save and invest a certain amount of money every week and let the dividends add up until you reach your goal. When investing for dividends, it's important to have a plan. Higher yield often means higher risk. Balance is key. So here's the summary. REITs offer high yields, often monthly payouts, and exposure to real estate, but they come with higher risk and can be volatile. Strategy number 3. Dividend Aristocrats. These are special stocks that have increased their dividend payments for at least 25 years in a row. To be part of this group, a company must have increased its dividend payout for at least 25 consecutive years. That's a quarter century of growing payments. Some of the top dividend aristocrats are 3M, Legate, and Platt, Walgreens Boots Alliance, Coca-Cola, and Procter & Gamble. These corporations, on average, pay a lower dividend yield than covered call ETFs and REITs. Typically, 2% to 4%, but they are very consistent. They are well-established companies that have shown growth over time. They also tend to perform better during tough economic times. So, how much does John have to invest to meet his goal? With a 4% average yield, John would need about $875,000. With a 2% yield, that number doubles to $1.75 million. Compared to covered call ETFs and REITs, dividend aristocrats require more capital, but they offer more stability and a proven track record. A good idea is to spread your investments across multiple dividend aristocrats to reduce risk. Different sectors perform differently. The beauty of dividend aristocrats is their consistency. These companies have increased dividends through every economic challenge. The trade-off is clear: lower yield, but more safety. If your priority is preserving capital while generating income, dividend aristocrats are a solid choice. By investing in dividend aristocrats, John has the potential to receive regular income from his investments. These stocks have a strong track record. So here's the summary. Dividend aristocrats offer lower yields, but unmatched stability. These are the blue chips of the dividend world. Now, let's bring it all together. Here's the math behind earning $2,900 a month in dividend income. First, the goal. $2,900 a month is $34,800 a year. Let's round it to $35,000 for simplicity. Here's what it takes with each strategy. Covered call ETFs with an 11.8% yield require about $296,000. REITs with a 10.8% yield require about $324,000. Dividend aristocrats with a 4% yield require about $875,000. Or you could combine strategies. Half in covered call ETFs, half in REITs. That's about $310,000 invested. This gives you diversification. How do you get to that $300,000? If you save $1,000 a month and invest it at 8% returns, you'll reach about $340,000 in 15 years. Want to get there faster? Save $2,000 a month. In 10 years, you'll have about $365,000. More aggressive, but faster. And don't forget to reinvest your dividends. This is the Dividend Snowball. Your dividends buy more shares, which generate more dividends. So here's the bottom line. With about $300,000 invested in high-yield strategies, you can generate $2,900 a month in passive income. Let's quickly recap the 3 strategies. Covered call ETFs offer the highest yields. REITs offer similar yields with real estate exposure. Dividend Aristocrats offer lower yields but unmatched stability. Each strategy has its own risk profile. Your choice depends on your risk tolerance and timeline. Here's your action plan. Choose your strategy. Open a brokerage account. Start investing monthly. Reinvest your dividends. Track your progress. Imagine checking your account and seeing dividend deposits hitting every month. $2,900. Every month. Without working, that's the power of dividend investing. And remember, this video is for educational purposes. I'm not a financial advisor. Always do your own research. If this video helped you, please hit that like button. Subscribe for more simple money tips. I'm Mr. Mint, and I'll see you in the next video. Remember, dividends are your money tree. Plant the seeds today and watch your passive income grow.